Hello class, this is Dr. Fenton. In this video, I'd like to talk about depreciation. First, let's define depreciation, and then I'll show you how to calculate depreciation expense using the straight line method. Now, first of all, depreciation is defined as expensing the cost of a long-term asset over its useful life. What that means is that for each year of the useful life of that asset, a portion of the asset's cost will be expensed. Depreciation expense is typically shown in the income statement as an operating expense. So depreciation, as it says here, is taking a long-term asset, an asset that'll last 2, 3, 4, 5 years or more, and then writing off as an expense the cost of that asset over all those years. So you buy the asset in year number 1, and even though you might pay for it all in year number 1, you're going to use it for, let's say, up to 7 years. So you're going to write the cost off, in other words, depreciate that asset over that 7-year period. Now let's look at an example to calculate depreciation expense using the straight line depreciation method. Now in the straight line method, we're going to have the same depreciation expense amount each year. And to calculate this, we're going to need the cost of the asset to the company, that asset's estimated useful life, and this useful life is something the company will determine. It will decide for a particular asset that it purchases, how long does it think that asset will be useful to that company. Then we'll need the estimated salvage value, that's also called the residual value. We'll need this. I'll show you the calculations in a second how we use this. So those are the items that we need: cost, estimated useful life, and the estimated salvage value. So let's look at some numbers. Let's say we have an asset that costs $5,000 and it's going to last 5 years. For this first example, let's just say that there is no residual value. So let's say 0. Now what we have here is on the calculations the cost, $5,000. From it you take the salvage value. In our example it's 0. And so the amount we're going to depreciate over the useful life of this asset is $5,000 in total. Now, $5,000, the depreciable amount, divided by 5 years, gives us $1,000 per year for the depreciation expense. So, each year for 5 years, we're going to have $1,000 depreciation expense. So that's the straight line method. It's the same each year. Now let's go back and change the numbers a little bit. Let's go up to an asset that cost us, let's say, $12,000. The life, let's keep it 5 years. And let's say the estimated residual value is $2,000. All right. So let's look at the results. Now here we have cost $12,000 minus the $2,000 residual or salvage value. And that means we're going to expense over this asset's useful life a total of $10,000. So $10,000 over a period of 5 years will be $2,000 per year. So that means that for each of the 5-year period, we're going to deduct $2,000 in each of those years. So $2,000 per year times 5 years equals $10,000 that we're going to depreciate in total. The adjusting entry each year will be depreciation expense is the debit. And here's the $2,000 that we just calculated. We're going to credit accumulated depreciation. Now accumulated depreciation, you might have talked about earlier in the previous chapter, but that is the account used in the balance sheet to keep up with the total depreciation we've taken to date on the asset. This includes all the years we've had this asset. This accumulated depreciation account is a contra asset account. It shows up the balance sheet, but it is a subtraction from the long-term asset that it belongs to. So, for example, in the property, plant, and equipment section of the balance sheet, you might have equipment and you'll show cost $12,000. Right under it, you'll show less accumulated depreciation, $2,000, if this was the end of the first year. Now, since you have the same depreciation each year, the entry is going to be the same each year. And so at the end of the second year, make the same entry, debit depreciation expense $2,000, and credit accumulated depreciation $2,000. that puts $2,000 more in the accumulated depreciation account. So at the end of the second year, you're going to have on the balance sheet equipment cost $12,000 less accumulated depreciation $4,000. Now the calculations we've had so far included in this box right here will be the calculations for if you purchase the asset at the very beginning of a year. So you have a full year's depreciation, $2,000 in that first year and for the next 4 years following. So it's $2,000 per year each year for 5 years. Now what happens if you purchase the asset later in the year? I have this example down here using the same initial numbers. And so here the purchase date is March 1st. So what will be different if we purchase on March 1st? Well, if we purchase on March 1st, we only have used the asset for 10 months this year, March 1st through December 31st. The first year's depreciation will be adjusted for part of a year. So we'll take the $2,000 you saw above, except that was for a full year. Now we convert that to 10 months over 12, a partial year. And the result will be $1,667. So $1,667 will be the amount we would replace in this first year entry up here as an adjusting entry. That's only the first year. Now years 2 through 4, or 2 through 5 really, we're going to depreciate $2,000 per year for each of those years. And then we have 2 months to spill over into year 6, and we'll have only 2 months depreciation in year 6. I wanted to show you this because if you buy the asset other than at the very beginning of a year, you need to prorate the expense for the part of the year that you own the asset. So I think that's about it. Again, this is straight line depreciation. It's the same per year, but it is a little bit different though if you buy it other than the first of the year. And so we saw the example down here is the March 1st. So I hope this video helps. So good luck with your studies.